Hi, everybody. My name is Thomas Holloway, and I'm a portfolio manager at Genus Capital. And welcome to the weekly video.
Hi, I'm Justin, macro research analyst for Genus Capital. Welcome.
All right, so I've got a few questions this week for Justin. Let's kick it off, Justin, with what happened this week.
So this week we saw the markets fall with heightened volatility due to the uncertainty heading into next week's elections. Economic numbers out of the US were better than expected, supporting the view that a recovery is taking place. We also saw a lot of earnings from the big tech names such as Facebook and Google, which were mostly in line with expectations. However, they were under pressure from regulatory fears as well as some pressures from the user base growth side. On the COVID front, Germany and France were headed for another lockdown for the month of November, but there are some positives coming out of the vaccine front.
Okay, thanks for that wrap. How about oil prices? There was a lot of excitement with oil prices earlier this year. I think they've kind of come back a bit, but what's our forecast there and how do we think about that?
In general, we expect oil prices for this year at least to hover around the $30, $40 range. It's been hovering around so far. Currently, our models view it as neutral. The concern regarding a second lockdown and the lower oil demand are present, but it seems like a lot of these countries have learned from their first lockdown and they're deciding to keep some of the factories open, which is good news for oil. Longer term, we still see oil range bound as well because of the digital economy and how it has changed people's lives. There's likely to be less traveling, whether it be for leisure or for business, due to the conferences moving online, as well as people being reluctant to travel, air travel on planes.
Yeah, that makes sense. Thanks. You mentioned in your intro that it was a busy week for earnings. What stood out for you and what are you keeping an eye on?
So yeah, yesterday was a big day for a lot of the big earnings. We saw all the FANG names, the Facebook, Google, Amazon, Twitter, those guys report their earnings, which were broadly in line with analyst expectations. We also saw continued strength in earnings from last quarter, particularly for Amazon, with the increased demand as people are still at home and trying to set up their work from home as well as taking classes from home materials. Overall, though, guidance in that sector was slightly lower, especially in the social media sector due to the regulatory issues that are going on that I mentioned before, as well as the user base being almost capped out at this point, and then companies are going to have to look elsewhere more globally rather than the US for that user growth.
Yeah, one incredible item I noticed, I actually read this on Twitter, but Apple, of course, has been a huge winner over the last 5 years, up something like 30% per year for 5 years in a row. But the operating earnings of that company are actually relatively similar to what they were 5 years ago. So how did they manage to return such incredible shareholder return? Part of it is that they've been buying back a lot of their stock, so there's fewer shares outstanding. And the other piece is that the market values those shares more highly per dollar of earnings than it did 5 years ago. Okay, so flipping over to more of the macro news, another piece of information we got this week was US GDP. For me, you know, GDP is released, it's a little bit backwards looking. By the time you get it, it's about a month old. But nevertheless, still a really important number for everybody. So how did that shake out?
Yeah, so for the third quarter GDP for the US came in slightly higher, growing at almost 33% on a quarter-over-quarter basis, ahead of the consensus 31%. We also saw Canada today report their August numbers, which were slightly higher than consensus, growing at about 1.2%. We're still slightly below on Canada and the US pre-COVID levels, with US being about 3 to 4% on the year-to-date number, but the recovery was very sharp with 33%.
Great. One point I wanted to make about that is that 30% growth sounds a little bit crazy. And so just to put that in context, the way that works is it's a quarter-over-quarter number, which is annualized. So I think the right way to read that is it's about 7.5% growth from the quarter-over-quarter, and then you multiply by 4 to make it annualized. Mm-hmm. And of course, what we had is about a 7% down and 7% back up again. So we're starting to approach roughly the GDP that we had pre-COVID, give or take. So that 30% number, while it sounds exciting, definitely reflects a snapback, as Justin explained. Okay, so I mentioned that GDP can be a little bit slow moving of a data point. Is there anything that we can look at that's a bit higher frequency?
Yeah, so the US releases weekly job numbers usually on Thursdays. So yesterday we saw that the US's initial jobless claims were slightly ahead of the consensus, only at about 750,000. This is the second best print that we've had since the pandemic layoff. Jobs are slowly returning to the workforce, with some spaces, particularly in the tech sector, even expanding and growing and increasing their workforce, which is a very good positive sign for the economy.
Okay, so in terms of specific investments in the portfolio, a big dichotomy that we've been talking about for 7 months is the kind of the COVID winners and the COVID losers. That theme's been playing out for a while. Whether we have another lockdown or not, can the COVID winners keep on winning? Is that dichotomy still going to be important going forward?
So we believe, yes, the COVID winners will still be able to make money during a full shutdown or even when the economy opens up, and still will probably make more money going forward. The way COVID has changed people's daily routines and people's lives will only benefit these companies more. We are seeing a partial or full adoption of work from home policies for many companies, especially in the tech sector and even spreading out to other sectors as well. This is because the changes in work from home technologies are making it much easier for people to work from home. And as well, in addition to this, we also see a lot of universities as well as other schools taking a learn from home approach as well, which will definitely be benefiting those companies.
Yeah, that reminds me of an item that I saw in the earnings this week from Microsoft CEO Satya Nadella. Pointed out that, COVID or not, basically every business is looking at digital transformation, and the next 10 years of economic progress really will be defined by digital transformation. That was probably already happening, certainly something we've already been talking about, but COVID, of course, accelerated that. So not the first time you've heard that story, but definitely reinforced this week with some of those anecdotal comments. Great. Well, I think that's all the questions I have for this week. Really appreciate that insight. Thank you. Thanks, everyone, for watching. Have an awesome Halloween, however you celebrate it. And don't forget that you can feel free to reach out to any portfolio manager with your questions, either for next week's video or for your own information. Thanks so much for watching.
Thanks, everyone.